Hey everyone, welcome to the first episode of the Nifty 50 series where we take a deep dive into some of the top 50 companies in India. The objective of this series is to help you understand the difference in approach that goes towards analyzing companies in different industries. In today's video, we'll be touching the NBFC sector and try to learn specific financial parameters that one must check when analyzing a lending business. The company that we'll be analyzing today to understand the NBFC sector is Shriram Finance Limited, which is one of the largest non-banking finance companies in India. To make it easy for you to understand, here is how I have structured this video. We'll first take a look at the recent restructuring that the Shriram Group has done. We'll then take a look at the business model of the company and the financial products it offers. Thereafter, we'll try to gauge the risks and opportunities that lie ahead for Shriram Finance Limited. And lastly, we'll analyze the financials of the company using specific financial ratios that are relevant for lending companies. In case you are new here, then do consider supporting this channel by smashing that subscribe button. There are three main companies that you need to focus on: Shriram Capital Limited, Shriram City Union Finance Limited, and Shriram Transport Finance Company Limited. The board of Shriram Group was of the opinion that there would be synergistic advantage if these companies were merged, as the compiled data from all these companies would help to cross-sell financial products as well as get more valuable insights using AI. So in FY 22-23, Shriram Capital Limited and the remaining undertaking of Shriram City Union Finance Limited were merged into Shriram Transport Finance Company Limited, and post that the entire firm was rebranded as Shriram Finance Limited. Now that you know about the recent restructuring that happened within the Shriram Group, let's now try to understand the business model of Shriram Finance Limited. So Shriram Finance is basically involved in the lending business. They have a comprehensive range of lending products such as commercial vehicle loans, passenger vehicle loans, MSME loans, etc. Now naturally, if a business is lending money, then you would also want to know, where does Shriram Finance get the money from? Well, in case of any lending business, you would typically find this information under mobilization of funds in the annual report. As you can see on your screen, for Shriram Finance, most of the money comes from three sources: term loans from banks, fixed deposits issued to customers, and securitization. Now some of you may have heard of securitization for the very first time. So let me explain it to you in a very simple manner. Let's say that Shriram Finance has given loans to a bunch of people. Now instead of waiting for the maturity period of those loans in order to get the money back, Shriram Finance can choose to use those loans that are already given to raise further money. Confusing, right? Here is how it happens. What Shriram Finance does is that it clubs a lot of loans together to create a package. This package is then sold to a special company that is created specifically for this purpose. This company is usually called an SPV or a special purpose vehicle. The SPV then sells this package in the form of financial products such as debentures or bonds. Now you may wonder, why would a person buy these financial products? It's because these financial products are backed by loans where the money will eventually come in. So by selling the loans in the form of a package through an SPV, Shriram Finance gets a large amount of money immediately instead of waiting for the loans to get paid over time. They are then able to use that money to give out more loans to people, and this entire process is called securitization. So coming back to the mobilization of funds, Shriram Finance raises money through different sources as listed on your screen, and thereafter lends this money to individuals and businesses in order to profit from the difference between the interest earned from lending and the cost of raising those funds. Now, before we get into the different lending products that Shriram Finance offers, you need to understand the financial term AUM or assets under management. From the purview of a lending company, AUM or assets under management is basically the total value of all the loans that the lending company has given. If one would want to compare the size of any two lending companies, then comparing the AUM would be the right way to go forward. A growing AUM is a clear signal that the lending company is giving out more loans and thereby increasing the scale of its operations. So now that you understand the term assets under management, let's take a look at the financial products that Shriram Finance Limited offers, and at the same time try to decipher insights into Shriram Finance's business. If you were to look at the latest quarterly investor presentation, then you would be able to find the segment-wise AUM breakup. From this table, it is clear that the company has 8 major financial products, wherein the top 3 hero products that contribute the most towards the company's AUM are commercial vehicle loans, passenger vehicle loans, and micro small small and medium enterprise loans. On a year-on-year basis, the highest AUM growth can be seen in MSME loans, farm equipment loans, and two-wheeler loans. Now, as important it is for a lending company to grow its AUM, it is equally important that the loans that are given are repaid by the borrowers. To manage the defaults on loans, lending companies typically follow the Indian accounting standard to classify loans into 3 stages. Stage 1 is when a loan is overdue up to 30 days. Stage 2 is when a loan is overdue between 31 and 89 days. And lastly, stage 3 is when a loan is overdue for 90 days or more. When a loan reaches stage 3, it is considered as a non-performing asset, and so the lending company needs to set aside some funds to account for the expected losses due to non-repayment of loans under stage 3. The regulatory body that sets directions and policies regarding the provisions related to bad loans is none other than the RBI. Now that you know that the stage 3 assets are considered as non-performing assets by NBFCs, let's take a look at the product-wise provisioning that Shriram Finance has done for stage 3 assets. In the table on your screen, you can see the financial products of the company along with the data of the financial assets in each stage. Since stage 3 is the most critical one, we are mostly going to focus on that. So if we look closely at this table, then in absolute value terms, the maximum default can be seen in commercial vehicle loans, passenger vehicle loans, and MSME loans. But for obvious reasons, these numbers are high because of the high AUM of these financial products. Now, if we were to logically decipher insights from this table, then you would have to look at the data in percentage terms. Clearly, the maximum default can be seen in farm equipment loans, construction equipment loans, and commercial vehicle loans. Now, there is one really good trend that can be observed for the company. Both MSME loans and two-wheeler loans have low ratio of default, and the company is witnessing a high growth in the AUM of these two financial products. If this trend continues, then the company's overall quality of loans would improve and the requirement for provisions would reduce eventually. Let's now take a look at the risks and opportunities that lie ahead for Shriram Finance Limited. Starting off with the risks, the first risk for Shriram Finance is its customer base. The thing is, Shriram Finance gets majority of its business from financing commercial vehicles, and most of these commercial vehicles are owned by SRTOs, that is small road transport operators. These SRTOs are actually susceptible to adverse impact during economic downturns, and therefore lending to this group increases the risk in case of economic uncertainties. The second risk is the competition from small finance banks, new age fintechs, and captive finance companies. Let's understand the risks from each of them one by one. Unlike NBFCs, small finance banks have access to a broader range of deposits, including savings and current accounts. The lower cost of funds translates into competitive loan rates for commercial vehicle buyers. At the same time, RBI's regulatory framework for small finance banks is more favorable, which allows them to aggressively expand in semi-urban and rural areas and therefore directly implement localized approach to target Shriram Finance's target market. As far as new age fintech platforms are concerned, they offer faster loan approvals and disbursals, which ultimately attracts buyers who value quick access to capital. Also, since fintechs operate with minimal physical infrastructure, their operating costs are much lower, and that allows them to offer competitive loan rates and flexible repayment options to the buyers. Now, before I give you the reasoning of how captive finance companies are giving competition to NBFCs such as Shriram Finance, let me first explain it to you what are captive finance companies. Let's say you want to buy a truck from Ashok Leyland. Now, Ashok Leyland wants to help you pay for the truck, and so they create their own special company just to give out loans to the people who want to buy their commercial vehicles. This special company would be called a captive finance company. This captive finance company becomes a direct competitor for NBFCs such as Shriram Finance because individuals who trust the commercial vehicle manufacturer would also trust the subsidiary of the same company. Additionally, this captive finance company can offer tailored financing solutions that perfectly align with the offerings of the commercial vehicle manufacturer. For instance, the captive finance company may offer zero down payment option, lower interest rate, bundled maintenance services, or even extended warranties, which frankly are quite difficult for an independent lending company to match. The third risk for Shriram Finance is commoditization of financial products. What it means is that the loans offered by different providers become so similar that customers view them as interchangeable. When this happens, the bargaining power of the customers increases and they merely look at the pricing of the financial products and the convenience of accessing them. Ultimately, it reduces the ability of Shriram Finance to charge higher interest rate for the same offering while also reducing its negotiation power to draft loan terms that are favorable for the NBFC itself. The fourth risk for Shriram Finance is political uncertainties and fiscal instability. See, NBFCs have very limited access to bank finance, and so they rely heavily on foreign investors to raise capital. Now, if there are political uncertainties, then that would drive away foreign investors due to concerns about the stability of returns and currency depreciation. As far as fiscal instability is concerned, if the RBI increases the interest rates for reasons such as controlling inflation, then the higher interest rate would increase the cost of borrowings for NBFCs because they rely substantially on banks and the debt market to fund their lending activities. This rise in interest rate would therefore squeeze the profits of Shriram Finance, and they might find it difficult to grow their loan book. Now that you have understood the potential risks for Shriram Finance, let's now take a look at the opportunities that Shriram Finance sees in the immediate few years. Firstly, the company sees a great potential for EV financing for personal mobility as well as commercial activities. What we can observe as of now is that more and more OEMs are coming up with newer EVs, and that is increasing the adoption rate for EVs. At the same time, the vehicle scrappage policy and the subsidies on EVs is further stimulating the demand for passenger as well as commercial EVs. Also, with the rising disposable income, people are preferring personal mobility solutions, and so Shriram Finance definitely stands a chance to offer tailor-made financing options for different segment of EVs. The second area of opportunity for Shriram Finance is the gold loan market. In a report by PwC India titled "Striking Gold: The Rise of India's Gold Loan Market," they mentioned that in the fiscal year 2023-24, the organized gold loan market was valued at 7.1 lakh crore, and it is expected to grow at a CAGR of 14.85% to reach a market size of 14.19 lakh crore by FY29. Coming to the third area of opportunity, Shriram Finance can cater to the credit gap in agri-tech and MSME lending space, especially in underbanked regions. With the growing adoption of agri-tech, agri-businesses require financing solutions for modern farming tools, machinery, and commercial vehicles. Now, as far as MSME lending space is concerned, there are 64 million plus MSMEs in the country, and only 14% have access to credit. The remaining unfulfilled demand makes up a huge addressable market for an NBFC such as Shriram Finance. Last but not the least, post the merger that happened under Shriram Group in FY 22-23, the company has the advantage of cross-selling and upselling financial products to a larger set of customers. This would increase the revenue per customer and help to build deeper relationship with the existing customer base. Now, coming to the most important part of this video, let's analyze the financials of the company using financial ratios that are specific to the lending industry. Let's start off with net interest margin. Net interest margin is basically the difference between the interest earned on loans given and the interest paid on deposits or borrowings relative to the total assets of the company. In FY24, the average net interest margin for non-banking finance companies stood at 6.6%. For Shriram Finance, the net interest margin in FY24 was 8.84%, which was quite above the industry average. A higher net interest margin indicates better profitability than other lending companies. Moving on, let's now take a look at the composition of loans in terms of secured versus unsecured. Secured loans are basically the loans that are safeguarded by a collateral. In case of non-repayment, NBFCs typically have the right to sell the collateral and recover the outstanding loan amount. Unsecured loans, on the other hand, are loans that are not safeguarded by any collateral. So clearly, the risk for a company increases if more unsecured loans are given out. As per ICRA, the average percentage of unsecured loans for NBFCs stood at 11% in FY24. For Shriram Finance, it can be clearly observed that out of the total loans given, only 8.21% of the loans amounting to 17,641 crores were unsecured. This shows that the composition of secured versus unsecured loans in case of Shriram Finance currently stands at a favorable level. When dealing with lending companies, it is of utmost importance to look at the liquidity coverage ratio to ensure that the company has the ability to withstand short-term liquidity disruptions. For example, NBFCs typically borrow short-term funds via commercial papers or short-term bank loans, and they lend that money for the long term to their customers. Since short-term liabilities need to be paid off quickly, but the funds that are tied up to long-term loans are not easily accessible, it can create a liquidity issue for the company. NBFCs obviously have the option to keep rolling over the short-term liabilities, but in case of economic slowdown or credit crunch, that might not be possible or if possible, it might come with high cost. At present, RBI, the regulatory body, states that NBFCs need to maintain a liquidity coverage ratio of at least 85%. As far as Shriram Finance is concerned, the MD and CFO, Mr. Parag Sharma, very proudly stated in the annual report that Shriram Finance has a liquidity coverage ratio of 195.55%, which is well above the regulatory threshold. Another important financial ratio that one must check when analyzing a lending company is the capital adequacy ratio. Capital adequacy ratio basically tells you how financially strong an NBFC is. It shows whether a company has enough money to handle the risk it takes, especially if things go wrong or unexpected losses occur. It is calculated by dividing the sum of Tier 1 capital and Tier 2 capital by the risk-weighted assets. For those of you who don't know, Tier 1 capital is the most reliable form of capital and it consists of equity capital and the retained earnings. Tier 2 capital, on the other hand, is the supplementary capital which consists of riskier assets such as undisclosed reserves, subordinated debt, revaluation reserves, and hybrid securities. Though not as reliable as Tier 1 capital, it does provide some buffer. Coming to the risk-weighted assets, these are basically the risky assets of the NBFC that could lose value. In easy to understand terms, high weights are assigned to riskier assets such as loan given to an MSME, and low weights are assigned to less riskier assets such as loan given to a government. Now the RBI guideline mentions that at any point of time, the Tier 1 capital cannot be less than 10% and the capital adequacy ratio cannot be below 15%. If we look at Shriram Finance, then the capital adequacy ratio for the financial year 23-24 stands at 20.3%, of which the Tier 1 capital ratio stands at 19.55%. By looking at this ratio, it can be said that Shriram Finance has quite good loss absorption capacity. Let's now take a look at the return on equity, which shows how efficiently the company uses shareholders' equity to generate profits. As per the latest investor presentation of Shriram Finance, the return on equity was 16%. Now an ROE above 15% is typically considered to be good. But what makes Shriram Finance special is that its average ROE has been consistently in the range of 14 to 16% over the years, thereby indicating consistent returns for the shareholders. Coming to the final leg of today's video, one should analyze the non-performing assets by taking a look at the trend of the gross and net stage 3 assets. If the stage 3 assets are reducing, then it shows better management of loan approvals and better collection mechanisms. On the contrary, if the stage 3 assets are increasing, then the company really needs to work on establishing early warning signals, conduct better risk assessments when disbursing loans, and focus more on secured lending. If you look at Shriram Finance, then the gross stage 3 assets ratio in FY 23-24 has reduced to 5.45% from 6.21% in FY 22-23, and the net stage 3 assets ratio has reduced to 2.7% from the earlier 3.19%. Since Shriram Finance already operates in a risky zone by giving loans to SRTOs and MSMEs, a reduction in stage 3 assets is always a positive sign for investors and deposit holders. So this is how you go about analyzing the financials of a non-banking finance company. As important it is to look at the profitability and liquidity position of the company, it is equally important to look at the different product offerings of the company and what kind of associated risks it brings for you as an investor. I personally wouldn't invest in Shriram Finance Limited because of its risky customer base, and I feel that there are other NBFCs and small finance banks which can give good returns like Shriram Finance Limited, but with lower risks. Keep in mind that this video is not any stock recommendation and you should do your own research before making any investment. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.